Good morning, ladies and gentlemen. As always, we start our review of the past couple of weeks' price action, as the last time we did a video, with a view of what is happening in the US fixed income market. As we thought for the past 2 or 3 weeks, we have entered a period of summer stabilization in yields. The price action is very consistent with the technicals. We have a very important level around the 195, 196 area in 5-year yields and 182 on the downside. Any movement beyond 182 will be surprising in the next week. So we think a period of stabilization between 182 and 192 and 193 on the upside is going to be probably all we're going to get next week. Longer term, the picture is very uncertain. We think it is more likely that we are going to break at some stage the moving average on the downside, this 200 period moving average, which is holding up the market beautifully after a period of indecision here, where this is where we are. But that is something that we don't have to decide about now, and we can have a look much later on. In the 10-year notes, this is a chart of IEF, which is the 7 to 10 year period in the ETF. We think that the price is going to be contained between 106 and 106.70, 80 on the upside before a resolution which we think will happen now to the upside rather than to the downside. But we think it's going to trade in this area for the next week or so. If we look at the yields, we are basically going to be range bound between 272 on the downside in yields and 238, 239 on the upside. This is going to be the area that will then finally decide the next move, which we think is going to be down in yield. We don't know what is going to cause it, but we are just getting an impression that the markets are way ahead of the Fed and way ahead of the economy. Everybody is positioned short in terms of price, and we think that is at the moment not really justified. The markets which are truly ahead of themselves and have very little upside in yield are the European markets. This is a weekly chart of the 2-year note. We can see that actually last week the 2-year came off in yield by 1 basis point, and this structure indicates that we are more likely to collapse down to -70 than we are to bust through the -52 area in yields. It is a sign of consolidation, while people are very, very bullish of yields in Germany. The 5-year note reflects it even better. We're outside of the weekly Bollinger Bands, and we are subject to a collapse in yields back down to the -28, -30 area if we get any disappointment out of Germany. The 10-year is more or less exactly the same. We are again outside of the weekly Bollinger Bands. We are unlikely to bust through the +63 area, and much more likely to fall down towards 40 basis points than we are to go through 60 basis points. So the yields in Germany and in Europe in general tell us that we are more likely to have a period of falling yields than we are to get a period of high yields in Germany. So far, we've told you that we think both the US and the EU markets are far ahead of any potential true action by the central banks. But it is not surprising that the market has really discounted the beginning of a tapering in Europe and also an acceleration of Fed tightening. We don't think the economic data that we're getting out of the US necessarily are conducive to an early tapering or end of QE by the Fed, but we shall see over the next few months ahead. And we certainly don't think that Draghi is going to start tapering just like that, which means that if you look at the difference between what the US yields have done and what the US dollar has done, this is a chart of DX, the dollar index, you see that a couple of months ago these two started diverging after being almost the same chart. While the 5-year note has held its range over the past few months, the dollar here broke and continued going down. If we have a look at the dollar index, these are levels, these lines we put in many months ago, if you remember, and we actually traded them very accurately on both the upside and the downside. The big level was 96.50, which was a swing level, and we know that while the market is above 96.50 it tends to go up, and when it's below 96.50 it tends to go down. You can see how beautifully 96.50 has held, and now we have the next level which is 96.07, which is where we closed on Friday, just a few ticks away from it. Now the only question that we have is 96.07 going to hold, or are we going to go down to 93.63 before a very sharp bounce in the dollar index? We favor the latter. We think 93.63 might trade in the next couple of weeks, but that will be a very good level to put on option plays looking for a move back up towards the 99 area where the 200-day moving average is. We think the market is way ahead of itself, and it's not really surprising. We have that kind of background where the people think that the Fed is now going to hold off on tightening, and the Europeans think that Draghi will start tapering in September or October. So the trend, the momentum is with a lower dollar, but we think that at 93.63, if we see it in the next couple of weeks, it'll be a wonderful place to actually start going against it and having long-term option plays looking for probably a 4, 5, 6% move up in the dollar. This is a weekly chart of Euro USD, which is 65% of the dollar index. As we can see, we have a 38.2 retracement level at 117.35, and over the next couple of weeks that level should be tested, but that is the level which is both a 38.2% retracement, and it will be caught by this very long-term moving average. That is where we expect the reaction to take place from, and to come down to at least 112, if not to 109, and test these moving averages before another move back up. In terms of equities, we are now beginning to see the final leg up of the final wave in the rise of the stock market since 2009. We are quite convinced of it. We have a market which is now being driven by a variety of factors, which is no one is selling. The second is the market is accommodating a weaker dollar, but how long is that going to last for? And therefore we think that the market is basically a sell at anything around the 2500 area. We think that over the next 3 to 4 weeks we might see slow consolidation to upward movement to around the 2480 2500 area, where we plan on having some very very long volatility positions, because we think there will be a dramatic reaction at some stage in both the dollar and US equities. You can see that the volatility spreads are coming up to sell territory, and we've always said at least a 2 or 3% retracement once the market has gone above 130. So we think that the S&Ps and the Nasdaq and the Russell are coming towards the end of their run. Whether they make one or two more highs, we don't really care, but we certainly think that the next we have probably 2, 3, or maybe 4% on the upside, while we're beginning to open up the downside to a move which is much closer to 10%. So the risk reward on longs is getting worse and worse, and the risk reward on shorts, especially in volatility, is getting better and better. This is a very important chart. This is a chart of volatility and a weekly chart of volatility, and a chart which showed you what happened in 2006 before the market turned in 2007. Volatility bottomed at 860 just before 2007 started, i.e. way before the market turned and topped. And volatility started rising into 2007 and finally exploded into 2008. But volatility went up throughout 2007, warning that something was wrong. We are very, very close to those levels. We closed at 951, so we only have 100 points on the downside before we can put on some major long-term positions looking for a much higher volatility levels. So we are looking to make many times our money. From 860 the market went to 86, so that's 10 times your investment, and we are quite convinced that much the same sort of thing is going to happen this time around. We think that volatility is getting to historically cheap levels where not being long of it would be a very, very bad mistake. Having said what we have just said about equities, there are absolutely no signs from any spread relations that we are starting any kind of move down in equities. This is XLP over XLY, so consumer discretionary over consumer staples. That market is still languishing at the bottom. Before the market can, this spread gives us any kind of signal to get out of stocks, it needs to break out above this 0.638 level over the 200-day moving average. As you can see, it is absolutely not giving that signal. There are no other markets which are giving us any signals about an impending collapse in equities. That is why we think we are still early, but it's always better to be early than late. These will confirm our view, and then we can have some very large positions going that way. This is gold over SPY, still coming off, still no reason to be long of gold rather than equities. In fact, quite the opposite. This chart is telling you still be long of equities over gold. If we look at other asset classes, this is SPY over IEF, which basically is the so long equities over 7 to 10-year bonds. It's still very much in an uptrend. It's above the 50-day moving average. It's above the 200-day moving average. It's about to test this line. So it's overbought, yes, but the trend is still long equities, short bonds. So that is not giving us any reversal signals. If we have a look at TLT, which is the long bonds, it's more or less exactly the same picture. It's still saying be long of equities over bonds. It might be getting overbought, it might be getting to levels that are a trading sell, but this trend, which started in 2009, is still very much alive. You are still making far more money being long of equities than being long of bonds. So we have absolutely, and we do look at about 40 different indicators. Not a single one is telling us to get out of equities for the long term and buy other asset classes like bonds or gold or commodities or whatever. So we do think that still the trend has not turned. We still have probably several more weeks into the summer of stock market strength, but at some stage the rug will be pulled from under equities. Interestingly enough, for all those people who have followed us from the beginning and know our view about FEU, which is basically the European stock markets over SPY, we highlighted the change in trend, i.e. the European markets are now stronger than the US market. A lot of people bailed out of Europe because of this slight correction, which all it did is take it closer to the longer term moving averages. The 200-day moving average of that spread is now beginning to roll over, which says that European equities are going to be favored over US equities. This to us is very interesting, and we think that we're going to have another leg down. Certainly we would prefer to see this much closer to the moving average because we have a natural stop at 741, but we are fearful that that move has now started, that European equities are going to outperform US equities for many, many months to come, back down towards this kind of level, which is basically around the 645 area, which basically means that we have at least another 4 to 5% worth of overperformance from European equities against US equities. The final spread relationship we'd like to draw to your attention is the one that we've been talking about for many months, EEM, emerging markets over SPY. You can see for how many years emerging markets have underperformed SPY, and now we are getting reverse signals. We're getting for the first time higher highs, and these are the levels we drew for you several weeks ago: 0.179 and 0.1763. We are now breaking the 0.1763, and the final level we need to break is 0.179. Once that has happened, that will be indicators that the long-term trend in EEM over SPY has turned, and we are probably going to have a very long-term move which will last many, many years, probably back up towards 28 to 30, this area here. So you're going to make much more money being long emerging markets than you will be long of the SPY, the US market. This is a very important long-term change of trend, and we are quite convinced that it's going to take place in the next few weeks and give objectives up which are many multiples of the trend that we've had so far. And in conclusion, our biases for next week. As we said, 10 basis point consolidations for 5 and 10-year notes. Bunds and Bobble, we are beginning to be very queasy of being short of them, being short of price, i.e. Being long of yield. we think that unless bunds can close below 160, the buy the dip is probably the favored strategy, not for positioning, but just for trading for 100 points or so. We would buy dips towards 160 with a stop below, and then be ready to sell them off at 161, 161 and a half. We think that is much in a range, and we don't think it can break significantly, as we showed you. Commodities are beginning to turn up from the lows they made, but it's still very unconvincing. We don't think that oil can really get back above 48 to 49 area, so we think the that area is going to be a good sell. We think we will see 48, 49 in oil in the next couple of days, so let's put that in. But we think it's going to be very, very tough to break that. So we would not be, we're not concerned that we are going to miss the commodity reflation trade by not doing anything now. So there you have it. ES, as we say, there's nothing in the tank. We wrote this, what, a month ago? 3 to 4% range for next several months. We are within that. The 4% would come somewhere around the 2500. We don't think the market has the legs to break 2500. Probably not for the next, not this year. That's what we think. And most of the action is now actually in ES against NQ. We showed you how XLK got oversold. We just missed buying it. It's now, what, 3-4% higher against ES. So that is where the market action is, all in the spreads, rotation between ES, NQ and Russell 2000. The Russell should now be leading. It is not, but we still think it has at least a couple of percent on the upside at some stage over the summer. So we'd rather be long of Russell than anything else for the long term. But the super cycle is working. Out of expensive US stocks into cheaper EM and EU stocks. We would naturally say apart from XLK, because as you know, we think XLK is America. If you bet against XLK, you are betting against America, and you're betting on a stock market more or less crash. We might get one of those very soon, but the timing is not now. You will see better levels to short XLK, and even then, for the long term, I definitely wouldn't want to be short of XLK. There are much more interesting things to short than XLK for the long term. European equities still buy a dip the market, especially against the US. That is all beginning to work. These are the important areas. The super cycle, so European equities and emerging market equities, far outperforming and will far outperform the US market over the next several months. DX, as we said, we're now probably within the 1 to 2% area of a significant bottom for the DX. We're looking for 117, 117.30 to put on option positions back towards 110. We do think we see it, but we would rather wait for those levels and then play for 110 than play now for 117. And unfortunately, we still think that this big trade has started, and we're still looking for good places to get in. We think we're going to get bounces now in Bobble and Schatz over the next few days. So maybe that will be the entry, but we will definitely tell you when we think the time is. Thank you very much indeed, and let's hope we have a profitable trading day on Monday and next week.